Hello viewers, today's topic is mutual funds, which is the most common and popular investment options in our country. It's bank deposit. But does it help you achieve your financial goals? Does it give you inflation beating returns? Does it help you create wealth? I'm afraid not. Still, 70% of Indians save their money into bank fixed deposits or leave it in savings bank account. Very few venture out investing in mutual funds. Let's understand what is mutual fund. It's generally confused with equity markets, but it's not. Mutual fund is a vehicle to help you reach your various financial goals, which may be creation of long-term wealth, which may be protection of the capital which you have accumulated, which could be tax saving, and several others. Let us understand what a mutual fund can do for an ordinary individual. If you are young and married with one or two small children, most popular goals or common goals which you will have are children education, children marriage, and then buying your own house and planning for retirement. Mutual funds can give you options to save money for each of these goals and help you achieve these goals in a systematic manner, much more convenient than any other option, and also give you the facility of anytime liquidity. What more do you require? But before you start investing in mutual funds, there are few things which need to be understood. First of all, what are the various types of mutual funds? There are debt mutual funds, there are equity mutual funds, there are balanced mutual funds, and also there are open-ended mutual funds, there are closed-ended mutual funds. Now, each one of them has a separate suitability for different individuals. If you are young, you can wait for long period, then you should choose long-term equity funds, and the best possible route is systematic investment plan, which is just like investing some amount every month to take care of your future goals. And systematic investment plans in equity funds should be well diversified into large cap funds, mid cap funds, and smaller companies fund. Also, some amount could be allocated to some thematic funds like a pharma fund or a contra fund or a gold fund. To decide as to how much should go into each of these categories, either you should consult a financial planner or you should follow a simple thumb rule. The thumb rule is that around 40% of your savings should go in a diversified large cap fund. Another 30% should go into mid cap and small cap fund, and the remaining amount should go into flexi cap funds or value style funds or infrastructure funds or contra funds or gold funds. This is how you should construct your portfolio and link your investments to various goals which we mentioned, like children education, children marriage, buying a house or retirement, etc. If you do not have a long-term horizon and your goal is coming up in 2 to 3 years, then you must stay away from equity funds. Then you should consider debt funds. Within debt funds also there are several categories, like there is a long-term debt fund which should be chosen if your goal is coming after 3 years. There are short-term capital funds, short-term debt funds which you should invest in if your goal is coming up in around 9 months to 18 months. If liquidity is not your immediate requirement, then you should consider fixed maturity plans. They are popularly known as FMPs. If your goal is to save tax, then there are wonderful options from mutual funds which are known as equity linked saving schemes, ELSS, where there is a lock-in of 3 years. And again, you can choose from a variety of tax saving funds like ICICI Prudential Tax Plan or Sundaram Tax Saver, Reliance Tax Saver, HDFC Long Term Advantage, Axis Long Term Equity Funds, etc. Apart from these, if you have money for a very short period, say only for 1 to 2 months, even then you should not leave your money in a savings account which earns you just a paltry 4% and that too taxable returns. You should rather put it into a liquid or liquid plus account where you can get significantly higher returns as compared to a savings account, which could be 6% to 7% or even higher at times, and that too if you go for dividend reinvestment option, even the dividend is tax free. So friends, it's important that you must construct your portfolio by including various options which are there in the mutual fund world, so that you lead a very comfortable life, you enhance your lifestyle continuously, you save tax also, you enjoy anytime liquidity also, and you would be remembered as a successful investor. So please do consider including mutual funds into your portfolio. Thank you.